A good operator can turn a mediocre deal into maybe a really good deal, but a bad operator can turn a great deal into.
And remember, your operator is the one sending you the documents about the metrics of the deal. If you don't trust the operator necessarily, how can you trust the deal?
I'm going to welcome Nicholas Moore. He is a commercial real estate and private equity attorney. He focuses in multifamily real estate and works with clients nationwide. How you doing, Nick?
Hey, man. Good afternoon, my time. Good morning, your time. Is that right?
Yeah. Hope things are. You didn't get caught up in that whole blizzard thing, did you?
No, actually, no. We avoided a couple of those, and I was in Orlando last weekend doing a boot camp for one of Michael Blanc's groups.
Okay, yeah. I think I saw some posts about that.
Yeah, and it was actually got chilly down there, man. It was like in the 40s and 50s. You should have seen the Floridians. They didn't know what to do with themselves.
Yeah. They're definitely on hibernation mode.
Yeah. We packed accordingly and still had fun at Universal Studios and all that, man. But yeah, we avoided the snow up here in Atlanta.
Love it. Jamie and I are going to be there in a couple of weeks, but hey, we only have a short time with you. Want to get to the question of the hour. You work with a lot of multifamily investors and syndicators. What should, and here the focus of this is more so on the passive investors, the investors that are looking to invest in multifamily from a limited partner standpoint, or however it's structured. But basically, they're not the operators; they're the ones providing the cash, the equity. What should investors look for when considering investing in their first syndication?
So I'm going to skip right past the obvious of look at the board and the managers and the operator and their work experience and track history, and go straight into the distributions to see how is your money going to make you money. You need to pay attention to the preferred return and see if you're already entitled to compensation through a preferred return that's paid before other distributions. Okay, and that can be helpful. Second is to look and see what is the return of capital profile for this investment. So of course we have return on capital, that's your distributions, whether that be a preferred return or common equity where you just get your pro rata distribution. In a refinance or a sale, particularly in a refinance, and even in some circumstances with cash available for distribution, what is considered a return of capital? It's very, and the reason I brought up the preferred return is it's very important to consider how the return of capital is predicated so that you know if the operator can pay you your capital contribution back where you'd otherwise expect it in a return, which would reduce the amount of return you get from your preferred return. Okay, so that was a lot of return words. But what we're saying is this. If you invest $100,000 and you have a 7% prep, you make $7,000 per year on that. Okay. If the operator can send you capital contributions back that reduces your capital account, your 7% would be assessed on that reduced capital account.
Yeah.
So if they sent your return of capital back of $50,000 and you may have thought it was distributions or otherwise, your 7% is now only predicated on that $50,000 and can wildly change that investment. So just see, most of the time you want to see that return of capital happen at a refinance or a sale, okay? But after you have met certain distribution thresholds, like an average annual return, internal rate of return, or cash on cash return.
Mm-hmm. And I guess further to clarify that, if say you're looking to deploy $100,000 and you want to make sure that's at work for the next 5-7 years or whatever the projected timeline is, they do a refinance event on year 3 and they decide to pay you 25% or half, make it easy. So 50 grand back. Well, now your overall return is affected. It's not that that's a bad thing. It's understanding that like possibility and how that flows within the operation. So what you're saying is investors should have a firm understanding of how that's going to impact their returns if that happens. Is that the plan? Talking with the operators, hey, what do you plan on doing when you refinance? Are you going to give us our money back, or how does that play out, right?
That's spot on. You just want to know, because look, operators could put crafty things in there where they could just pay your capital contribution back early, and then they're responsible or obligated to a lower return. And you want to know that so you know that there's not an event that they can cash you out basically when you haven't realized the full potential of the investment that you were expecting or anticipating on the front end.
And then this is where having a good attorney on your side, like yourself, can help make sense of the devil's in the details. And it's not that operators are, maybe trying to do anything malicious or anything like that, but it's just you got to understand it. I mean, those are the terms, those are how they're going to be operating and abiding by. That's what you should expect. And how is that going to affect your expectations?
That's exactly right. And so just look at that waterfall, have an attorney review it, even if you're on the LP side, spend a few bucks just to make sure that you understand all the implications of the investment. And from there, trust your operator, make sure they're well vetted and they've got a good performance history, and invest with confidence.
And have you seen, and I mean, these things can get as complicated as you want, but have you ever seen a situation where they're in with a certain equity percentage, but if a capital event happened from a refi at some point, it actually changes their equity percentage in the deal? Or
typically when it's bought out, that can be the case. So if you have a pref only position in class of units, you'll see that once that preferred return is paid out on a certain measure, that their interest will be bought out. The common equity, not so much, unless they put a clause in there that allows for that. So you see it more with pref, less with common.
Okay, because I've seen how the common equity can change. There's really only one or two instances. Typically, that stays pretty static. But yeah, if they're giving you your capital back, it's going to affect your overall return. What are some of the biggest sticky points or concerns that you're seeing from? Let's switch to operators. So operators may be coming to you, hey, got this issue, or I don't, maybe not. I've got this issue with some of my limited partners. They thought this, but this happened. Is there anything that operators should be doing better to provide better clarity on expectations for their investors? So ultimately, this is to mitigate problems. Better communication, less problems, right?
Yeah, I mean, for sure. I mean, look, the manager is going to have latitude and discretion. That's why you need to trust them. And that's why having performance history and all that is so important, because there's typically a basis that you can work from. But ultimately, providing those quarterly reports, having investment reports, and just communicating with the LPs is going to provide the peace of mind where, those LPs will come back and they'll reinvest. And I think that's, taking the long view. So having a good investor relations team is critical. If that's too much responsibility for the operator, they should hire for that. Because I've noticed it be, a distinguishing factor with many GPs. But ultimately, try to stick to your strategy as close as you can on what you've advertised in your PPM. You may have the latitude and discretion to do something different or to alter that. But to the extent you execute on the strategy that the person kind of relied on in making the investment, the more reliable you appear, and again, earn that trust of the LP.
Last question: which is better, the deal or the operator? Which is more important for the LP to consider?
Operator. Deals don't run themselves. Properties don't run themselves. You got to have an operator who knows what they're doing. Even better, the operator that has a property manager that knows what they're doing.
Yeah,
is a great opportunity. You'll find the deals. The deals are out there, and to the extent you operate them well at the property and the asset level, you're in store for what should be a profitable future.
Yeah, a good operator can turn a mediocre deal into maybe a really good deal, but a bad operator can turn a great deal into.
And remember, your operator is the one sending you the documents about the metrics of the deal. So if you don't trust the operator necessarily, how can you trust the deal if they're the ones giving you the info on it? But if you trust the operator, then you can trust, the deal.
Love it. All right. Thank you so much, Nick. It was a real pleasure.
Thank you.
I'll talk to you again soon.
Take care, brother. Thank you so much.